Good morning from our global headquarters in New York. I'm Manus Crenny. Welcome to Bloomberg Brief. Let's set your agenda. Yields dip and stocks bounce. Back from the biggest loss this month as strong data pushes back the expectations of Fed rate cuts. The G7 finance meeting in full swing. Our interview with the EU Economy Minister Paolo Gentiloni coming up. And as Citi, HSBC and Barclays all call for 5 days a week in the office, citing new FINRA rules, well, we'll bring you the HSBC CEO's view on that here in the United States of America. So we're counting down to a interesting day. What did you learn yesterday? Which was don't fight the Fed. That certainly was it. From Bostic to the PMIs being the highest in 2 years. Not even Nvidia it could undo that sentiment as Nvidia ramped by 9%. Bottom of your screen at the moment, you've got that little bit of a bounce back. Nvidia was up 9%, $218 billion off a rally yesterday. But even Nvidia rallying so couldn't invoke the spirit of a rally in the equity market. Definitely yesterday it was Jerome 1, Jensen 0 in terms of the markets. It could be the first weekly loss in 5 for the equity market. But looking at the bond market, what you've got is the twos popped by 8 basis points yesterday. So coming back ever so slightly, it was the data that won the sentiment. The short end was fearful. It was the tail that wagged the risk dog, really. There is a growing narrative of no rate cuts. And then copper. Remember Monday? It was at $11,000, up 40% in 3 months. It's the worst weekly loss since February. However, the skew is still bullish. So where are we with traders? They're certainly pushing back on interest rate cuts, with the Atlanta Fed President Raphael Bostic reinforcing the view that the central bank needs to be patient as growth is taking longer to slow than in previous cycles. Joining us now is our MLive correspondent, Noor Al-Ali. Noor, it was a rough day at the short end yesterday, to say the very, very least. And I love what John Arthur said. It was basically, Jensen 0, Jerome 1, taking the PMI and, of course, the narrative. When you look at the bond market this week, do you think we're capped out at around 5%? Do you think that the pessimism on rate cuts is all fully priced?
Yeah, absolutely. And good morning, Manus. Look, there's a lot to take in here. The Fed appeared a lot more hawkish than we had originally anticipated, and the volatile swaps market didn't like that minutes reading that came out. Then the economic data came, and it was like a double whammy on markets here, because they had just come back and said, well, hold on. The Fed has been saying that we need to pause and just think about the very high inflationary dynamic that we're still in, that exceptionalism that we're seeing in the U.S. economy. Now, of course, jobless claims and continuing claims did point to the fact that maybe we're starting to see some weakness feed into the economy, but not to the degree that would warrant, the 3 rate cuts that the Fed had originally jotted in March this year, and certainly not even 2 at this point. I think the question now is, do we even get 1 cut, or do we get a lot of holds and then potentially maybe 1 cut this year to carry us through into the next?
Listen, I thought it was quite interesting yesterday. Nvidia was up 9%, yet the S&P 500 managed to end the day down. And if you'd taken out Nvidia, which is 6% weighting in the index, it would have been a pretty hefty negative day. The chip stocks took a hit. They're trying to stabilize right now. But talk to me about the possible rotation that we're seeing. I mean, this Nvidia results was supposed to be, a Damascene moment for risk, and it was far from it.
Yeah, absolutely, Manus. And this is a pivotal moment for markets yet again. We were hoping that stocks could continue to ride that Nvidia rally and those gains and that optimism that we've seen in the past earnings cycles. Not this time, right? Nvidia, as you say, rallied, as John Authors argued as well, and stocks didn't really reap those benefits. It's because that rate dynamic is still playing a big role into this. And, you had a size and scope there on stocks closing out lower this week. We've had, earlier remarks from different strategists throughout the market say that we're potentially reaching that sell signal. So there's a lot of caution in markets. There's a lot of fear as well that this higher rates dynamic is going to influence stocks eventually. But look, I mean, if you take a step back here, you'll see that actually yields are much higher because, and rates will continue to stay higher because the economy is actually doing quite well. And that will ultimately be good for stocks. So there's a lot of arguments here that you can say, but ultimately I think we're still in a good place for stocks, even in a short term. And a lot of people will look at the levels that we've come across now and they'll say, well, maybe this is a good re-entry point for me, at least for now.
I love what John Arthur, I would encourage everybody to go and read John Arthur's piece, because there's actually, you realize that's one smart man. Atlas shrugged as the bond market stole Nvidia's thunder. And of course, he's referring to Atlas being Nvidia, holding everything in terms of risk sentiment up. Look, the other market that I touched on was copper. Monday was $11,000. Here we are. We've given a little bit back. I mean, it was a parabolic move by any stretch of the imagination. The debate is going to be as to what extent this market has a supply-demand imbalance and to what extent it's just at the beginning of a potential demand destruction, because the skew is still bullish.
Yeah, absolutely, Manis. And look, we're just talking about Nvidia here, but remember, copper is very much on the long term an electric vehicle AI chip plate, because copper is the kind of metal that is, the future of metals is really where copper is, right? When we talk about, for instance, oil really being a relic in terms of how demand is really shifting away from that, copper, however, has that long-term approach where, a lot of the gains that are currently coming in right now are pricing in that future of the great impact that this metal will have on the different sectors that we've just discussed. But in the short term, the kind of short squeeze that we've seen here in copper is really reflective of the wider short squeeze or the wider spikes in commodities that we've seen in recent years, right? It's a whole new dynamics that traders aren't really fully pricing in yet. And I argue about this in a column that's coming up later today, where I say that commodities have been spiking and kind of coming down. You've seen it in cocoa, you've seen it in sugar, you've seen it in coffee, and copper is one of those as well, but obviously each to their own, for their own reasons. And now the big thing is, are we at a point where markets and central banks will have to accept that inflation will continue to be higher, driven by these spikes? Or is it that we're at a point where these inflationary spikes that are led by commodities are a lot more temporary? So there's a lot more dynamics here that markets are still adjusting to, and it's incredibly interesting.
They really are adjusting, and we're going to hear from the HSBC CEO a little bit later on, and he made it very clear to me, look, get used to, we're in a different regime. We're in a different tariff regime, trade war regime, we're in a different rates regime, and if anything, the past 10 years were an anomaly on the rates regime. So get used to the new normal, which then takes us to the regime of higher for longer, and that is something that we're probably going to debate. With Torsten Slot talking about the lack of the transmission mechanism. We had the Peterson Institute, Adam Posen, with the surveillance team on Monday, even mooting the possibility again of a rate hike next year and the folly of closing the door on that. When we look at the bond market specifically, Noor, it's still grappling, I would say, with what the length of real higher for longer is, because we vacillate between 2 cuts to practically no cuts, 2 cuts to sort of less than 1 full cut in December. So I don't think that the long end of the curve is utterly convinced that rates are off the table.
Yeah, absolutely. And look, the dynamic that we're in today is not one that tells you, oh, central bankers are completely certain of the path that they're going to take forward. They've told us time and time again, they're cautious. They're going to be adopting a meeting-by-meeting approach. That's what the ECB has said. That's what the Fed keeps pushing back against, because, and even the BOE, even though they say, earlier in the last meeting, the BOE did say, look, markets aren't really, rates can go higher than markets are anticipating. But now you'll see actually, in fact, that even the BOE has said, look, we're closer to the Europe dynamic. Inflation is coming down. The economy is doing okay, or at least we think it's taken a corner. But still, markets are still not really certain. Yields have definitely come much higher. There's a debate here to be made whether they've fully priced in those expectations of easing much later or not. But ultimately, I think the question here remains, with that volatility that we get in bonds, how will that feed through into the rest of the risk sentiment and the wider assets out there? The dollar is surging. Stocks are still quite resilient as well. Yes, they're not doing as much as well this week, but look at how many new record highs we've set in the U.S. equity market alone. in this dynamic. So imagine a scenario where the Fed does start cutting rates, where a dollar does start coming down. What happens to yields then? And I think that's the room, and that's where the interesting debate begins on the different trades and the different types of strategies that investors would adopt.
Indeed, and we just had the PGIM CEO there with Francine talking about the money market funds and the very fast and furious flow of money that will come from that. He assumes that that will be a gusher of money and probably into equities. Noor, thank you so much for the coverage this morning. Our Bloomberg Live editor there, Noor Al-Ali. Other stories trending on your Bloomberg channel. This Friday morning, the crypto industry is on the cusp of another major landmark. The SEC has approved trade products tied to Ether from CBOE, NASDAQ, and the New York Stock Exchange, opening the door for a spot ETF. Ether continues to gain on the bets that ETFs are coming. The Commodities Futures Trading Commission is ordering JP Morgan to pay $200 million for supervision failures. The regulator says the bank failed to properly monitor billions of client orders between 2014 and 2021. In March, JP Morgan was fined more than $300 million by the Fed and the Office of Comptroller of Currency over similar gaps. Over at Starwood Real Estate Income Trust, they're taking a drastic step, imposing tighter limits on investors' ability to pull money from the $10 billion fund. Now, the move is the latest indication that the higher-for-longer interest rate cycle that we're in is causing cracks in the commercial property market. Just months after ending 5-year hiatus, Boeing has again stopped delivering airplanes to customers in China. Now, this is a fresh roadblock in the company's push to restore its battered reputation. Separately, Boeing is said to be willing to, is still burning through cash this quarter and in the full year. Coming up in the show, we're going to catch up with Cayla Seder of State Street. Where does she believe the Fed is in the cutting cycle? Propensity to cut, we discuss. But first, we'll catch up with the EU Economy Minister, Paolo Gentiloni, from the G7. That's next. Context matters on Bloomberg.
We should definitely avoid any kind of trade war. The trade war is neither in the interest of the US, nor China, nor Europe, nor any country in the world. But nevertheless, we have an issue with the unfair trade practices, with the high level of subsidies, and with the industrial overcapacities. I'm the Minister of Finance. I'm also the Minister in charge of economy. And I will spare no effort to defend our industrial interests.
Defending the interests, French Finance Minister Bruno Le Maire speaking there at the G7. Let's get to the G7. Oliver Crook is on location in Stresa in Italy. The EU Economy Commissioner Paolo Gentiloni is alongside him. Oliver, good morning.
That's right, Menace. Thank you very much. And we heard Bruno Le Maire talking about China and trade and sort of equal playing field. That's one of the big topics here. The other big topic will be how to get that financing for Ukraine's defense on stable footing for the years to come. I'm very pleased to be joined by Paolo Gentiloni to talk about some of the main themes and things we've been discussing here at the G7. So let's deal first with this, the Russian frozen assets, how to go about dealing with them. Are we close to a deal and a compromise on how to use those assets?
I would say we are working on this in a very good atmosphere. From our side, the EU side, as you know, a few days ago, we finalized our proposal to dedicate the windfall profits from the freezed assets, and we will start to disburse to Ukraine the first tranche of this decision now in July. Then here we are working to try to maximize this and to find the best way to do this as fast as possible. Again, using the windfall profits of the assets. I think having seen the discussion in the G7 in the last months, I think we are narrowing the differences and we are addressing mostly the details of these decisions. So I'm confident that in the coming weeks we can...
So you think we'll have an agreement by the G7 leaders meeting?
I think at least a political agreement before the leaders G7 is possible.
And I want to also get your take on sort of how China, what sort of space that occupies in the conversations here. We heard Janet Yellen speaking about it yesterday. We heard Bruno Le Maire today. Is the G7 unified on how to sort of address the question of Chinese overcapacity?
But for sure, the G7 needs to be unified. To have a unified approach in the EU view, we need to strengthen also our mutual exchange of information, our monitoring, because to have a common approach, we also need to share information on measures to be taken. And this is, I think, what everyone around the table of the G7 is agreeing. Of course, we are, especially us, the European Union economy, we are very interested in a balance. From one side, we have to face Chinese overcapacity and industrial expansion. From the other side, we don't want that this de-risking compromise the advantages of global trade, which are very important for the European Union. So how to find this balance is very important, but I see unity in the G7 table.
And you think that you can get concretely, because the problem is that the U.S. can move a little bit faster, it throws up trade barriers, and then a lot of that overcapacity comes over to Europe. So how do you deal with that problem as the European Economy Commissioner?
But of course we are not in the condition to know if there is a redirection of Chinese to
it's happened,
Europe.
for example, in the solar industry.
Yeah. At the same time, the amount of electric vehicles that China is now exporting to the U.S. is not so huge to make us have a threat that these are diverted to Europe. So the problem is not the immediate impact of this decision, but it is the principle that to have a united approach, we need to share information in the decision that we take.
And debt is the other sort of elephant in the room. It's something that obviously you're thinking about within the European Union. You're beginning sort of your infringement proceedings. How do you expect that to go within the EU? How do you get debt under control within Europe?
Well, we are not the one with the highest level of debt in the room. As you know, in the EU we have 83% of debt. But of course we have our fiscal rules that are back there, renewed, reformed, and they will address the high level of debt in some countries without, I think, creating problems to growth. The positive note is that finally the European economy is moderately, slowly again in the growth path. This is very important.
But growing a lot slower than, for example, the United States, which is really causing some issues, particularly on the rate path divergence. What do you think the risk is to the European economy of the divergence between the Fed and the ECB?
Well, I think that the path of inflation decline could be different. I'm sure that the ECB will decide their monetary policy independently from what the Fed decide. At least I don't see any risk of a different orientation from the ECB in the short term. Then, as always, the ECB will decide on the basis of the data. But what the markets are expecting, I think it's realistic that in the coming months we will have a reorientation of monetary policy towards the declining of interest rates.
And a very quick question. There's been an election called in the United Kingdom. Could a different government, a government perhaps less hostile to the European Union, mean closer ties between Europe and the UK?
Well, closer ties are what we expect. I have to say that we reached a very good agreement with the existing government, but if closer relations are possible with a new government, we are very happy.
So some optimism from Paolo Gentiloni. He's the EU Commissioner on the Economy, joining us here at the G7 meeting of finance ministers in Stresa, Italy. Manis.
Ollie, good to end on an upbeat note as you go into the political battle in the United Kingdom, and we heat up here in the United States of America. Oliver Crook on location at the G7. And don't miss our exclusive interview with the ECB Governing Council member Joachim Nagel. That is from the G7, 10:30 a.m. in New York, 3:30 London time. You just heard Gentiloni there talking about the divergence in terms of rates. Well, here in New York, the leaders are tackling a number of issues, including housing crises and crime. Yesterday, I caught up with Catherine Wild, the CEO of the Partnership for New York, which is a business group composed of the city's largest companies. We started our discussion on the contentious issue of bail reform.
Bail reform is really not so much of an issue. We've got issues in what's called discovery laws that were reformed that make it very difficult for the prosecutors, for the district attorneys to bring a case. So we've seen dismissal of cases go up 50% on technical grounds because of the laws. And that's where the challenge is. And I think we're going to make sure that something is done about that in the legislature next year to try and get that fixed. But it is a small course correction. We actually have a very balanced criminal justice system, and we're working hard to make sure that we enforce it.
The second issue is housing. 95% of New York's housing is technically unaffordable for workers on average wages. So let's talk about big New York, not the top 1%. What more? There's no quick fix on this. But what more can New York and the city do in this regard? Converting older premises to housing. What are you advocating?
Once again, it took a little extra time, like 2 years, but we have now passed legislation which creates a new housing production program which provides for, as we mentioned before, the conversion of older commercial buildings to residential. It provides for upgrading illegal basement apartments so that they're safe and sanitary. It increases the zoning allowances so that higher density housing, more units can be built. We are on track to address our housing problem. As you say, there is a lag time, but we're definitely on track. It is top priority. We want that young talent to be able to move to New York and not have to live 5 to an apartment. So we're working hard on that issue.
We're going into full electioneering mode between now and November. What is the sentiment? What is the partnership talking about in terms of the upcoming presidential election? Highest risk and highest opportunity?
Well, I would say the upcoming presidential election, we're a little worried that all of ex-President Trump's criminal trials have been brought in New York, or several of them. So that, you know, we're concerned that if he's elected, he not take it out on New York. Hopefully, because he's a Queens boy from New York, he won't.
Do you think he'd seek retribution?
I hope not. I'm just saying that's a worry in New York. And then on the upside, our New York economy is doing well. We're driving the national economy in a positive way. And I want to say that we're the capital of finance because companies like HSBC, who are global giants, couple centuries of global giants, have chosen to make a commitment to New York, to move into a place like Hudson Yards, to invest here, and they're very committed here. So that's really important to keeping us a global financial capital, regardless of who's president.
What's the talk in the partnership about Jamie Dimon going to Washington? Would you be all cheering that on? Is there a discussion about that?
Well, we certainly don't want him to leave before his new building opens on Park Avenue, because that's a multi-billion-dollar investment in New York City, and we want to see J.P. Morgan safely ensconced in their new building. So, but we could do worse as our next Treasury Secretary.
Thank you very much, Kathy, for joining me on Bloomberg today.
Thank you for having me on.
There you go. Never far from a J.P. Morgan quote. Catherine Wild there, the CEO of the Partnership of New York, and some of the biggest issues on housing and crime here in the city. Coming up, we're going to catch up with Cayla Seder of State Street. She believes the Fed will cut rates. When and by how much? Those are the questions we'll put to her right here on Bloomberg. A very good morning from New York. Context matters. From our global headquarters in New York, a very good morning. I'm Menace Cranny. Let's set your agenda. Yields dip, stocks bounce after the biggest loss this month on strong data, pushing back the expectations of Fed rate cuts. The G7 finance minister meeting in full swing. Our interview with the EU Economy Commissioner, Paolo Gentiloni. And Citi, HSBC, Barclays all calling for 5 days a week in the office, citing the new FINRA rules. Well, we bring you the HSBC USA CEO Michael Roberts' take on that very issue. Good morning. It's Bounce Back Friday. Don't fight the Fed. You know, good news was not good news for the rates market yesterday. And I love what John Arthur's had to say, which was, you know, Atlas, i.e. NVIDIA, holding up the whole equity market. Well, NVIDIA put on $218 billion worth of market cap yesterday, up by 9%. But the rest of the market struggled, and that may send you a signal of perhaps something else going on under the belly in equities. Are we near a peak? We can debate that in a moment. The short end of the curve actually popped by 8 basis points yesterday. The PMIs were the highest since 2022. It was an 8 standard deviation surprise. I'm going to say that again because that really shocked me. This was an 8 standard deviation surprise on the PMI. So that's what you call a robust economy. And copper, remember Monday? That was $11,000. That was 5 days ago. It's the worst week since February. Is it demand destruction or a reality check on the speculators in this market? By the way, the skew is still bullish on that. You've got NVIDIA at the bottom of your screen, just adding 0.2%. $218 billion is what we put on top of the cake yesterday for Jensen Huang. Well, the markets battled between NVIDIA and the economic data, and yields surged, seeing strength in the business activity at the short end of the curve, as I say, up by 8 basis points. Cayla Seder of State Street writes this: the market is its own worst enemy. Until there is a clear trend that inflation is sustainably back on track to 2%, cut expectations should not be adjusted to September or sooner. I'm glad to say she's with me side by side this morning. Good to see you this morning. So if we look at yesterday, short end popped by 8 basis points. It was quite a reaction. I mean, I was shocked to see an 8 standard deviation sort of outsized delivery on the PMI. But you look at this, and again, the rate cuts got pushed back and less. I mean, are we living in hope of rate cuts now versus the reality of this economy?
Yeah, and thank you for having me. You know, I really think in terms of market expectations, the market we've seen this year really get ahead of itself a little bit. And I think sometimes that's really because of this ultimate faith that cuts are going to be, you know, the next move is going to be a cut. Yeah. And I think when we look at some Fed speak and even in some of the minutes, we are seeing some signs that transmission of policy is working and feeding through the markets. So yes, that means we're probably not going to see a hike next, but that doesn't mean we're going to see a cut anytime soon. Can
you tell me where you see the most manifestation of transmission mechanism? Torsten Slok was here the other day talking about a bifurcated society. Yes. And so it's much harder. It's much harder to get the transmission mechanism through to the upper end of society versus the lower end of society. Where are you seeing the most impact of transmission?
Certainly on the lower income spectrum. And I think that's why when we look at how inflation has adjusted over the last year or so, we're really not seeing much progress in terms of services or in terms of housing, especially on that housing front, right? So this week we got a bit more housing data, and even though the volume of sales is lower, actual prices continue to accelerate. And so I think that really speaks to some of the stickiness that we're seeing. And so going back to the consumer, yes, we've seen some progress on the goods side, but until we see more signs of more of the consumer adjusting their spending habits, which may not happen until and if we see labor market weakness, because they're not feeling it on the home front, right? It's really hard to get that transmission into services and into housing, which we need to see to get inflation back to 2%.
Which maybe goes to what Bostic's point yesterday, which was it's just going to take, you know, higher for longer is just going to take a lot longer. You would say rates are capped out, short end of the curve are capped out at around 5%. What are the consequences of that?
I think in terms of equities for the summer, that actually could be a good thing if we're not going to see a bounce back up in yields beyond that 5% in two-year yields. So I think in terms of asset allocation, and we're seeing this in some of our proprietary data where we're seeing movement out of cash and back into the equity space, actually.
How would you describe the scale of that flow? Because that is the great debate, isn't it? Whether you go now, if you believe higher for longer will endure to the end of the year, are clients not tempted to hold on in these CDs? Or what is the scale of, let's say, the movement from cash to equity?
You know, I think part of that is where are you going within equities.
Yeah.
So sticking with the large cap quality growth, because really that's where we've seen some of this, seen the best performance in terms of being able to hang on to earnings growth, being able to hang on to revenue growth, things like that. And so that's really why we aren't tempted by some of the, every now and then these upticks in small caps are broadening out. I think it'll still be pretty narrow.
What did you make of yesterday's action? If you look at NVIDIA, John Arthurs has this lovely line, which was, it was Jerome 1 and Jensen 0. In other words, NVIDIA was up 9%, market cap added over $200 billion, $218 billion. But the reality of it is, under the hood, you saw AMD, Intel, a couple of the other chip makers had less dramatic impact. But if you take out NVIDIA, there was not this euphoric kind of rush in the equity market. SPOOs were down on the day. It's the first weekly loss I think that we're going for in 5. So taking out NVIDIA, what did that say to you?
You know, I think that's why we still see continued concentration. That's why we're not super excited about some of these more conservative or I'd say lower growth parts of the equity market. One thing that was really interesting ahead of earnings is that we did see a lot of outflows out of the tech space because there was a lot of earnings risk and there was a lot of concentration. The bulk of earnings expectations were really concentrated to tech and tech adjacent. And so once they were delivered, we started to see those inflows again. And so, you know, I would expect to see something similar within other parts of tech moving forward. And
just, you know, and again, if Danny was here, I think this is homage to Danny, it's about small caps. You would say we're not at the bottom of the cycle.
No.
So you're not convinced. So if we're higher for longer, okay, we don't quite know when those cuts will come. You're not overly convinced on the size and the scale of the cuts. So therefore, you're still reluctant to buy small caps and breadth.
Yes, definitely. And I think, too, because of that, we're still, in terms of regional outlooks, we still actually like the U.S. better than other regions, even if it's an elevated for longer environment, because the quality of U.S. equities versus other regions, you still have high quality, relatively high growth. And so from a relative perspective and regional allocation, we still like the U.S., even though we might get cuts last.
And again, one thing that we've touched on this week is whether risk is stretched, whether the sentiment is stretched. In other words, Citi seeing some of the highest risk momentum in a couple of years. Do you get the sense that there's any level of exhaustion in this rally?
I think it's concentrated. And so because we're seeing selectiveness, that is a sign that, you know, we're not in this huge risk-on environment, but we do have a risk-on bias. Because when we look at...
Is it risk-on or is it FOMO? Because that was the other one that I saw from Morgan Stanley this week, which was that the flow of money is more about FOMO than it is about actually really wanting to be involved in that market.
I think that definitely could be part of it. And I think it's all about relative choices, right? I think for now, equities are still attractive within that large cap quality growth space. And until we're continually seeing enough cuts to really stimulate other parts of the equity market, you know, we're still going to be selective.
Okay, no, it's the barbell approach. I've heard it time and time again, which is tech to the left, and yeah, you're still holding that tech and cash on the left-hand side. Cayla, thank you so much for being with us this morning. Closing off what's been a very interesting week at the short end of the yield curve and equities. Cayla Seder there of State Street. Coming up, SpaceX has $200 billion in valuation. It mulls selling existing shares. More on the story on Bloomberg. Context matters. Good morning from New York. It's Bloomberg Brief. I'm Menace Cranny with you in New York. SpaceX is considering selling shares at a price that could value the private company at around $200 billion. Tom McKenzie is with me. I'm looking at Elon's tweet from last night. SpaceX has no need for additional capital and will actually be buying back shares. We do liquidity rounds for employees and investors every 6 months. So, with that in mind, if he doesn't need the money, why is he doing it now?
Yeah, well, he's saying, look, this is an opportunity, of course, for existing investors and their employees, rewarding them, essentially, for holding on and being part of that ecosystem. So it does happen, he says, about every 6 months, and indeed we've got evidence of that. It happened about 6 months ago, but $180 billion was the valuation then. This time they're looking at selling, or at least the tender of shares of between $108 and $110 per share. So yes, it's a way to incentivize, of course, existing investors who want to maybe exit or at least capitalize on some of this upside that's come through, and employees. He says it's not about a capital raise. We've got plenty of liquidity. We'll be doing the buybacks. I think the reason we're interested, this is the most valuable privately held startup in the US. The way they've moved the dial so significantly across the space industry, and the fact that they could be listing potentially Starlink, part of the business, possibly by the end of this year.
When you see an Elon Musk story and then you look at the news conference that he had yesterday and how that was handled in terms of answering questions on Tesla and some of the issues around Tesla, around his remuneration, the domicile of the company. I mean, he has a lot of external issues going on at the moment. So what are we investing in? SpaceX or reputational issues with Elon? They are inextricably linked, aren't they? How do we get a piece of this? Because it was hot potatoes when I was in the Middle East. People were walking around going, do you know anybody that can tie me into a bit of SpaceX? I said, what do I look like, a broker?
Yeah, look, reputational risk is real, and it's something that existing investors at Tesla, some of them, have flagged around concerns, particularly around his concerns, the handling of X. So that is a really legitimate issue. I think a lot of people would say, look, the team that run SpaceX are phenomenal, is what the argument they would make. They've got these multi-billion-dollar contracts with NASA. They've got the fundamentals. How you buy this, you either become an employee, you buy off an existing VC who wants to sell out maybe, but you have to be an accredited investor in the US. That means 2 straight years of $200,000 plus in terms of earned income, or a minimum of $1 million in net worth, not excluding, by the way, your duplex in Manhattan Manor. So that's one way. Or you get exposure via a fund that has some exposure to SpaceX. That would be another way.
Tom McKenzie, you lighten the day on a Friday at a mortgage rate of around 6.5% to 7%. The duplex will have to wait. Tom, thank you very much. Tom McKenzie in London, tracking the SpaceX story. The Biden administration cracking down on China with tariffs, and the world's 3 dominant economies are entering a combative phase. That was the narrative as I sat down and spoke exclusively to Michael Roberts, the US and America's CEO at HSBC, about how this may affect business.
Clearly, we're in a period of rising tariffs, rising quotas. Don't know what the Chinese response will be to the latest tariffs put on by the US. But, you know, trade liberalism is certainly in a different phase than it was in the past. So I think we have to accept that. Our companies have to accept that. So a couple of responses. One, we're there to provide that advice. We're the largest trade bank in the world. We have abilities to really help companies manage their trade wherever they may be. So if a client is exporting from China, as an example, and wants to move that production capacity outside of China, we can help them. We're the largest foreign bank in India. We're a significant bank in Vietnam, a very big bank in Mexico. So we're really there to help them navigate through this unpredictability. I think that will continue. Regardless of what happens in the elections, we will have more tariffs, more quotas, a less easy trade environment to navigate going forward.
If I said to you, what's the biggest lever for the business in the near term?
Yeah.
Is it going to be rate cuts from the Fed or a clarity in politics and tariffs?
I think it's both. I think you need predictability. Companies need predictability to make their investments. Investors need predictability. What we haven't had really is that predictability. Lots of discussion on interest rates, lots of discussion of when and by how much. Now you've got the quota uncertainties. I think policy needs to be predictable. So if there's a rate cut, fine. If there's not, then it's the question of how companies then react to that. How do they then build their businesses to exist in a rate environment which is higher than it has been the last 15 years, but I would argue that the last 15 years have been an abnormal rate environment. So if they have that predictability, they can adjust their own production, they can adjust how they run their companies, and I think they'll do much better, but they need policy predictability.
But herein lies the point for the commercial bank. Let's just square that away, which is, many people say to me they've refinanced a great deal, have refinanced on the retail private side.
Yeah.
Do you think that's the same for corporates? Are they holding back on doing deals, doing M&A, doing
debt capital markets as a result of uncertainty?
Yeah, I think they were in the past. I think last year was certainly a reflection of that uncertainty.
And we've jumped over that now.
We have jumped over it. If you look today, the capital markets are on fire. We've had $750 billion of issuance in the debt capital markets for investment grade. Spreads are the tightest they've been in a long, long time. There's a lot of CLO formation of capital for the non-investment grade market, which I think will continue. And even the equity market, we've seen a lot more IPOs, led by the tech sector, of course, but IPOs are trading very nicely now. A lot more activity. So I think that sense of predictability is coming back.
So you would say no cuts in America in jobs in those businesses?
I would say we're fit for purpose, and we will always, change, we'll always react. It's a dynamic process, but we're fit for purpose.
To accelerate that bump that you've had in business, do you think rate cuts will re-accelerate that? I know you're on the table for limited cuts, but do you think a shift in the rate environment can materially shift the business?
I think rate cuts will be important, but not determinant. So I think, yes, it's important to have rate cuts. Again, I'll go back to this predictability statement. If rate cuts come, it provides predictability. I think you'll see the capital markets grow even more. I think they're poised to do so. As I mentioned, lots of capital formation, money sitting on the sidelines, but it wants to be put to work. So as soon as we can see predictability, I think you'll have even greater growth in the capital markets, both debt and equity. And I think we're well positioned to take advantage of that. We've got lots of discussions going on. Lots of sentiment is turning positive today.
Do you think it is better culturally for the people of HSBC to have an internal person versus another new person come in?
Yeah, and look, I think we've got a lot of good internal candidates. I think there clearly is an advantage for having someone who knows the institution. I think the board's going to take that into consideration. They already had a succession plan worked out. They were very focused on making sure that they would have a very quick, efficient, and very targeted succession plan. They're looking at both external and external candidates. Their decision, obviously. But I think, very important that you bring the right person in who has the right culture, the right mindset, and the right set of skills.
We have one debate going on in Europe about getting everybody back into offices, back into trading floors. FINRA are fighting back, saying, look, we're offering flexible working. You're probably one of the most flexible banks in the world. How do you see that for Wall Street? How important is it for Wall Street getting back in 5 days a week? What do you say to that?
Yeah, so FINRA has, as you mentioned, changed the rules, and we're adjusting accordingly. And we're going to follow the rules like everyone else. We are a hybrid bank. What we did not want to do is to force people to come back simply at a decree. So what we did is we built a building, this building, Hudson Yards, in the financial capital of the world, which really reflects a lot of input from our employees of why they want to come to the office. Because we did this during COVID, and we didn't know if anybody ever wanted to come to the office again. And so we built something that is very, conducive to people coming back. They want to come back. And so today, our overall attendance levels are at 80%. Before we moved, less than 40. We're running out of space very quickly, and luckily we just took some additional space in this building. So I think we will adjust to the FINRA rules. We'll make sure that whoever needs to be here 5 days a week will be here 5 days a week. But I don't want to decree people coming back. I want them to come back because they want to come back. And they do so, and they're productive, they feel good about it, and that's essentially the environment we have built today.
And that was Mike Stewart's conversation with Michael Roberts at HSBC. He doesn't want to decree that you've got to be back in the office. And a mighty fine space in Hudson Yards it is too. Coming up, a little bit more Fed speak and Treasury market closing early for that 3-day weekend. We'll discuss what's on your slate. Context matters on Bloomberg. Good morning.
I think that the path of inflation decline could be different. I'm sure that the ECB will decide their monetary policy independently from what the Fed decide. At least I don't see any risk of a different orientation from the ECB in the short term. Then, as always, the ECB will decide on the basis of the data But what the markets are expecting, I think it's realistic that in the coming months we will have a reorientation of monetary policy.
The EU Economy Commissioner there, Paolo Gentiloni, speaking to Bloomberg a little bit earlier, and we will bring you full coverage from the G7 later this morning. The ECB Governing Council member, Joachim Nagel, joins the team at 10:30 a.m. Eastern Time. Stay tuned for that. Let's set your agenda for the rest of the day. Before you leave for Memorial Weekend, Fed Governor Christopher Waller will speak at 9:30 a.m. Eastern, and we get durable goods at 8:30 a.m. plus University of Michigan consumer sentiment at 10 a.m. All eyes down for that. Treasury market closes early, 2 p.m. That is for your Memorial Day holiday. Some micro movers for you at Workday Sinks. They're cutting subscription revenue guidance, also delivering mixed first quarter results. Keep an eye on Intuit extending its decline on weaker than expected outlook despite raising its full year revenue. And then AMD, keep an eye on this. You know, a number of the chip makers had a really tough day yesterday. AMD was down by 3%, along with Intel, along with a number of the other chip makers. So there is some reprieve there this morning as Nvidia added 9%, $218 billion in equity capital value yesterday. And of course, Dan Ives says we're at the beginning of a new tech bull market. We're up 1/8% this morning from myself and the team here on Bloomberg Brief. Have a lovely long weekend for Memorial Weekend. If you're traveling, enjoy it. And surveillance is up ahead. Context matters on Bloomberg from New York. Good morning.